Thank you very much, Mark, and thank you everyone today for joining us. I know your schedules are very busy. So today I'm going to talk about the quest for all-weather alpha. It's not something we can always achieve, but it's something that we're always striving to achieve. What do I mean by all-weather alpha? I mean outperformance that's not tied to any one investment style, any one investment thematic, any one sector. The way we look to do it is by combining the very best value, the very best growth, and the very best quality names within our portfolio globally. Okay. The strategy that I'll talk about today is the Plato Global Alpha Fund. It's developed market equities, MSCI World Benchmark, and critically it's 150% long and 50% short. So by being 150% long, it means we've got 50% more firepower to invest in our best ideas so we can supercharge returns, but we also have that 50% short component. We've generated 90% of our outperformance to date actually on the short side. Some environments are fantastic for longs. This is an environment that it's the best in a generation for generating short alpha, and I'll explain why shortly. The strategy can fit into your portfolio as a core allocation. The volatility of this strategy is very, very similar to the volatility of the index. Okay, so it's not a very super high volatility strategy, or it can easily be a satellite allocation as well. So I mentioned this all-weather focus. I think many managers that have been super concentrated, particularly focusing on one thematic, when they get it right, you can have extraordinary returns. But if you get it wrong, you can have very painful drawdowns. So we're very much more of a steady as she goes, looking to outperform and add that alpha every month, every quarter, and every year. And we do this by combining the best of a range of different styles and thematics. So value names. What value names do we like in the portfolio? Well, it seems extraordinary to me that BMW, a storied company like BMW, you can buy at 6.5 times next year's earnings. The long-term PE for BMW is closer to 12. Okay, so we're buying it at about half the level that we ever have been able to historically. And you might say, oh, well, Tesla, they're all the rage in EV space, that's where all the growth is. Well, Tesla's growing at 35% annualized revenue, quite a clip. But BMW is actually growing their EV fleet, albeit from a smaller base, at 100% over the last 12 months. So that's been a key name that we like compared to Tesla trading at a PE of 73. I know certainly over the next 5 or 10 years where we would prefer to be invested. And certainly since we entered the trade at the end of 21, that's done very well for us. If you look at growth names, and particularly in the pharma space, people, if you think about the pharma names, you might think, oh, Merck, Glaxo, Eli Lilly. Novo Nordisk is a name that you may not be as familiar with. It's the third largest pharmaceutical company in the world. I've been invested in this company for over a decade. And they're a company that has essentially cornered the anti-obesity drugs. In many ways, the blockbuster story in pharma over the last 10 years, I think most people would say, would be immuno-oncology. Over the next 10 years, it's going to be anti-obesity. Obesity's it's tripled since 1975. It's associated with 200 comorbidities. If you can reduce obesity, you can reduce the disease burden on society so very substantially. And they have an 80 to 90% market share in approved drugs in this space. So I think that's a tremendous opportunity and has done very well for us as well. So a great growth name to counterbalance that value bias in the portfolio as well. I can't stand it when fund managers just put up names that have done well and every name seems to have done well and sometimes their performance hasn't done well. So ASML is a name that I've also been invested in for some time, and it's how we look to play the AI revolution. And I think it's fair to say if you ask most people if they'd heard of ChatGPT and large language models prior to last November, most people hadn't. And in such a rapidly evolving space, it's very hard to predict who the eventual winners and losers will be. It could easily be a company that we've never even heard of or doesn't even exist yet. So our approach here is very much a picks and shovels approach, where we invest at the very apex of the supply chain. All of the most advanced chips that are used in the large language models and AI today are produced by machines, the deep ultraviolet lithography machines of ASML. They've got a 90% market share in this space. It's a company that has 20 billion a year in revenue and a 40 billion backlog. So by combining these great quality names, these great value names, and these great growth names, we can give a smoother journey through time. This chart here shows the performance of the strategy since inception relative to the MSCI World benchmark. So we've consistently outperformed the benchmark, whether it was a value severe bear market on the left-hand side, or when the market went gangbusters, AI was all the rage, and we've still outperformed then. So by not being tied to any one thematic or one style is one of the key ways that we look to drive consistency. I just want to spend a couple of minutes on the macro backdrop. I think the elephant in the room is what's happening with rates. If you look at the economic history, what's going on just recently is almost unprecedented in 100 years, where you had rates that were so low for so long and inflated the valuations of everything from NFTs to crypto to profitless growth companies that in a normal environment would have been put out of their misery some time ago. What's really fascinating though is we've got this rapidly hiking up interest rates, and the fight against inflation is not done. It's going to be a couple more years before we get core inflation back where we need it. But already you're seeing some of the biggest increases in default rates globally in 10 years, and that's already starting to bite. What does that mean? Well, it's created some tremendous opportunities on the short side. And you can be a fund manager. Some fund managers are brilliant at picking winners. Picking losers and the risk management associated with that is definitely a unique skill set. The secret sauce in our arsenal to allow us to do this is a system of over 100 red flags. The genesis of this red flags process was actually back in 2014. I was invested in a Spanish tech company. It had been a tremendous investment for me. It had gone up 45-fold. And we were patting ourselves on the back thinking that we were investment oracles. The Spanish Prime Minister came out and said, this company is the leading light in Europe. It's going to be the next unicorn. Sure enough, after you get a kiss of death like that from a politician, you know that it's time to run for the hills. 2 weeks later, it's uncovered as a massive accounting fraud. Stock price goes to zero. CEO gets indicted for fraud. And we said, let's make damn well we never make that mistake again. So we did a really thorough post-mortem, and we missed some relatively basic things. Firstly, they were using an auditor that virtually no one else was using, very obscure auditor, and they were paying that auditor a tiny amount, indicative that the revenue wasn't really there. So we said, okay, well, let's go through every single corporate failure over the decades and build up a toolkit of red flags. So we looked at Enron, poster child for related party transactions. We looked at the big banks during the GFC, where there was a total misalignment between incentive structures and shareholder value, no clawback provisions. So slowly but surely we built up this toolkit of red flags. What's really interesting is that a company has one red flag. Maybe the CFO just left. Maybe the CEO just sold down their stake. That typically doesn't give you much of an edge, about a 51% edge, not much better than a coin toss. But when you put together over 100 red flags across corporate governance, forensic accounting, financial distress, you see that the whole is much, much greater than the sum of the parts. And it's actually our most powerful way of identifying landmines on the long side that we want to steer well clear of, but even more importantly, great shorting ideas. What we show here, and this is evidence from the last 20 years, is if a company has 8 or more red flags, and there's a few examples here on the right-hand side, that company, on average, over the next 12 months, underperforms the market by 20%. So it's very, very big numbers, and this is a very powerful tool that we have. So a few names that we've been short to date that have yielded 60 to 80% returns for us, Delivery Hero, BWX and Star, and you can see some of the red flags associated with those. Another big short that I think both as a sector but also in terms of individual stocks, commercial real estate I think is a bit of a basket case. People talk about stranded assets being coal mines, but I think you can look out these windows and you can see many stranded assets, buildings that are going to have to be demolished if they want to be occupied. So Lend-Lease, for example, is a name we've been short. It's generated 25% for us. Ultimately, you put all that together, combining the very best opportunities in value, growth, quality, and then use red flags to avoid landmines, generate some alpha on the short side. And you can see that we've generated very strong performance. After fees, outperformed the MSCI World by almost 9%. But equally pleasing, I guess, is the upside and downside capture on the right-hand side. So in up markets, we're doing 25% better than the market. But in down markets, when that sort of protection is so critical, we're protecting capital better than the market as well. So it's really a pretty simple story. Combine the very best of value, growth and quality opportunities globally to give us a nice diversified return stream. Very hard to know if value or growth stocks are going to be in vogue over the next 12 months. So just take the timing decision out of it and be diversified across those three styles. And then make sure you're avoiding the landmines. You know, Buffett was always fond of saying that there's only two rules you need to know in investment. Rule number one, don't lose money. Rule number two, don't forget rule number one. And that's what the red flags is really all about, preserving capital so we give you a smoother journey over time. So thank you very much for today. And if you want to have a one-on-one meeting or a meeting with the team, please reach out to the BDMs and we'd love to come see you. Thank you. Thanks, Dave. And because you